And do you think there's a particular type of property or age that you couldn't claim any depreciation on, or do you think that it's worth having a look at anything that's bought, or do you have any thought around that?
Yeah, and that's a good question, because I think that is probably the main issue, that myth there about, can I even claim any depreciation? The big question is, can I even claim any depreciation? It's secondhand. That's probably one of the biggest questions always asked to an accountant from their client. And I think that's the issue, the reason why I think a lot of accountants may miss this for a lot of, taxpayers, is that because the accountant essentially is taking a guess or don't know, that they're not in the right place to advise either an accountant, because strictly, an accountant will provide advice on tax legislation, but the legislation does say that if you want to organize a tax depreciation schedule or claim depreciation on your building asset, you need to engage, suitably qualified persons like a quantity surveyor or someone that can work out construction costs. For example, your builder gives you an invoice for the construction. You could use that as a piece of evidence to the ATO, and if you don't have that, in the most cases of a second-hand property, which might be old, you will then need to engage a quantity surveyor who can estimate the cost of construction with retrospective valuations on, say, get provisions of an index from a property that's built in 1990, and use that index and apply it to a square meter rate. And then we can say, okay, well, back then it would cost us $180 a square meter to build a property or something like that. And using those rates, we could then apply that to organize a depreciation schedule and forecast that cost for 40 years. And so the biggest question is that we most often get is, can I claim depreciation on a second-hand older property? Is that, yes, there are some limitations. Now, we have to then we delve a little bit deeper and then look at the two assets of depreciation. The two classes is plant and equipment, and which is generally your fast wear and tearing assets like
washing machines,
anything
dryer,
that's motorized, correct. Door closers, the hydraulic door closers, they're plant equipment assets. Loose furniture, they're not motorized, but they are considered plant equipment because of the nature of them being able to move. Of course, you can move something. Usually, a tall boy will fall apart faster than a built-in wardrobe. So they class that. And so those assets there will be depreciable, but in second-hand properties, we can't claim those type of assets anymore. The legislation did change in the 9th of May 2017, but we'll go into that a little bit later if you wish. But capital works, that's probably going to be the key one, especially for your clientele that are buying existing properties. If they are still doing that, they will be able to claim capital works, which is essentially the definition of building depreciation. So anything that includes slab, frame, brickwork, plasterboard, joinery that's fixed to the building, your ceilings, your roofing, they're all capital work assets. And so they will depreciate at 2.5% in normal use properties. In manufacturing, they'll depreciate a little bit faster, but commercial...
What does that rate go to then?
That goes to 4% if you've got a commercial property.
Okay,
that's in manufacturing.
For sure.
And if you've got a commercial office or warehouse or a normal residential house, they're at 2.5%.
And are we still talking about the same time period?
Yes, that's right. So the cutoff date for capital works is 1987. So anything built from 17th of September 1987 will be able to claim depreciation on capital works at 2.5%. Okay. But we can't claim on plant and equipment if there's second-hand plant and equipment on a purchase. You have to purchase those goods from a retailer like the Good Guys to claim depreciation. And the reason why they came up with the 9th of May 2017 legislation for the plant and equipment depreciation limitations is because of pretty much the fact of someone could go pull a dishwasher from their house, stick it in their home and say, you know what, here's a second-hand plant and equipment. I'm going to claim that. And that's what it used to be like. You could go into a property that was built in this property here would have been built in the 60s. You could go in here and, you'd have an old air conditioning unit. You might have some old lighting, old curtains. You could go in here and still claim that piece of curtain, the old lights, consecutive amount of times through consecutive amount of owners and still claim a residual value. So even though that someone bought it, say, 50 years ago for $150, today, if you had purchased the property today, we could go in there and go, you know what, the replacement cost of that curtain would be $50 and we'd be able to claim the second-hand value on that. And because it's less than $300, we could write off $50 in the first year, which is great. But then I think the issue was that the limitation is only to residential owners. You can still do that, for commercial property, but in residential, they limited it because of the problem of people over-claiming the second-hand assets. But needless to say, capital works hasn't been changed at all. And that is the 17th of September, 1987 cutoff for construction completion.
So yeah, to summarize the myth that people think because it's existing, I can't claim it, is you've just unpacked that, which is awesome. But for a lot of people that they're not sure what they can and cannot claim, is it easy just to get a quote, or what's the best way to go about it so they can do their due diligence as
We
well?
live in a very fortunate time, and RP data is a very powerful tool.
Yep.
Most of the time, I would say probably more than 95% of the time, we'd be able to pull out a construction date of the completion of that property. And so what it takes is for someone to give us a call and say, hey, I've got a property. Can I claim depreciation? It costs them nothing to find out.
Wow.
And of course, with the tools that we have in this day and age, and even when the construction dates are wrong, and we always, like you're probably familiar with, RP data shows so much information regarding photographic evidence of not just the sale, but also rental. And you'll be able to tell from there what type of build it was, to give a guidance on the estimation of depreciation for the first few years. And using that data, we might say, okay, you've got a building here. It looks borderline 1995. It's definitely going to be able to claim somewhere around that $1,500 to $2,000 per year annually. And as a tax deduction, if you're on the regular, on a normal tax rate of say 30%, you'll be claiming somewhere about $700-800 a year.
Wow.
And so naturally, they do the math on that. If it works out for them, $700-800 from 1995, you get a 40-year depreciation schedule, last until 2035. You've got another 13 years to claim. If you purchase this today, you're going to be well ahead at $700 deduction refund per year as a guideline.
Yeah, it's 10K. Yeah.
Not taking into consideration a lot of other things, but yes, as a guidance, and that should only be better for your high income earners as well.
And have you got any stories where like someone's been like, oh, depreciation's not going to work, it's not going to do anything, and then you've actually like blown their mind or anything like that?
Yeah, so I think when we started this in 2015, it was a big shock to not just I think the industry, but to us. We were like, we've been in the business for only a couple of years, and we've been so used to everybody who came to us to get a depreciation schedule. The minimum we'd be getting is $4,000 or $5,000 tax deductions in the first year because of not just the capital work, but I could round up all the plant and equipment in the house, which in a brand new house would, today cost maybe $30,000. I would be able to value those assets at maybe $10,000 for a property that was built in 1980, which is not eligible anymore, but 1980s. And I'd say, these residual assets were probably worth $10,000, a couple of split system air cons, old curtains, old blinds, shower curtains, things like that. Yep. And then I'd round them up and I'd give them $4,000, $5,000 tax deduction in the first year alone. Wow. That was the norm. And then so come around like 180, a couple of years later, and we've got this legislation change, and all of a sudden we've lost all that $3,000, and now we're quoting people $1,500, $2,000. So it's been a big shock to a lot of investors in that time period. But I think the biggest thing for us is the education piece, because depreciation hadn't changed at all in so long. Because of the legislation in 2017, it became a story, a topic of discussion. Right. And so I think I felt that necessary, we were more sort of in demand to extract knowledge out of, because we had to know the legislation to apply to our depreciation schedules. And so we were having that discussion, and people became used to it. And I think over time, people got comfortable with the fact that a $1,500 or $2,000 tax deduction for a property that was built 30 years ago is okay, because it becomes a cash flow tool. I think that's the biggest key driver for this topic, is that depreciation isn't, it's not a get rich quick thing. It's definitely a tool for professional property investors to get ahead, because every dollar counts. And that's what we try to educate people on. It's not like, hey, yes, we're not getting the $15,000 tax deduction on a brand new house, but if we're getting $2-3 from the ATO, that $700 refund is a good cash flow tool for a reinvestment, for whatever it is, or a holiday, or whatever it is to help you get along. And I think it's really important to know that. And I think, to be honest, most of our clients who are buying those older type properties, they've become very comfortable with that, because they're very much around the idea of, we need to drive every dollar that we can.
I like that.
Especially when the dollars come from the ATO.